Recession. It was a wild week in the markets this week, but the 3 hours again dominated the story. Russia, rate hikes, and recession fears. And so what we want to talk about is the Fed meeting that happened earlier this week.
Right. The FOMC, as expected, did raise the Fed funds rate 25 basis points. But I think more importantly, we got a little bit more of a flavor for what the Fed participants believe. We saw that the Fed is now looking for 7 rate hikes this year, although that's a median number.
And I think, Derek, that was way more than we expected. We thought we were going to get the quarter point, but for them to come out and say there was going to be so many rate hikes really was interesting to the market, and the market did react to that.
Initially it sold off, but I think just, it's the old story, the people don't like uncertainty. So once we got past the Fed meeting, people started to refocus on what earnings look like, what the economy looks like, and what the prospects are in Russia and Ukraine.
Yeah, for sure. And that was the Russia. But, let me just go back to that, because I think there is no doubt that we're seeing the end of quantitative easing, this term that we saw come out of the 2008 crisis. So we've had this money printing and then the Federal Reserve increasing their balance sheet now for about a dozen straight years. And now they're going to start to unwind that. And quantitative easing may be coming to an end. And that is very important for those companies that really relied on easy money.
Yeah, they're done purchasing assets. They said that during their conference call. And the question now is how are they going to attack that balance sheet? Because it's one thing to let bonds expire. It's another thing to actually sell them.
Right. And so we'll see how they do that. The balance sheet now $9 trillion. And, I talked about the financial crisis back in 2008 was about 1/10 the size. So this could be going on for a long time. It really meant, Danny, that the rising tide raised all boats. And so there was companies that really didn't do well that were being survived by easy money. And so we're going to have to watch that. The other thing we certainly have to talk about, of course, is Russia. And we really don't know what's happening. We've kind of laid out a potential what we think could happen and what the market's reaction to that would be. But obviously, nobody knows how this is going to play out.
That's absolutely right. And, one of the things that also occurred as a result of Russia is price of oil went to $130 a barrel. It actually was below $100 at one point on Thursday, but still a 20% increase since November. And that's had a negative effect on consumer confidence. And that's something we have to track as well, because 70% of the U.S. economy is driven by the consumer.
Which one of you guys said that gas prices go up like a rocket but come down like a feather? Because they have not come down.
They haven't moved at all, right? But we saw oil prices come down, and that certainly made a number of stocks move, like airline stocks and those who were heavily connected to fuel. They did rally based on that news. And, of course, the last thing, because you talked about consumer sentiment, is recession. That is our third R. And, of course, that is something we have to watch, because if sentiment starts to slow down at the same time that the Fed is starting to increase rates, that could slow down the economy. We've reintroduced the term stagflation, a stagnant economy with inflation.
Right now, the Atlanta Fed is looking for 0.5% growth of GDP in Q1. That's partially due to a very strong rebuilding cycle in Q4. So we kind of borrowed some demand from Q1 into Q4. And our expectation is Q2 will see some restocking. But, that's pretty close to zero. And again, the market's going to sniff it out and discount the future.
But, the Fed spoke this week, and they did say interest rates and inflation and recession fears were low. Inflation was expected to be about 4%, which you and I both, our eyebrows went up because of course, it was at about 9% with the PPI. And so all of this means that you go through your portfolio and there's companies that are going to do well. And there's no doubt that companies' balance sheets and their income statements are going to mean more now than ever. So go through your portfolio, know what you own, why you own it, and how much you're paying for it. And it's so important.